Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%, still low by historical standards, but almost a full percentage point above its level in early 2023. The cooling in labor market conditions is unmistakable.
That was Federal Reserve Chair Jay Powell moments ago speaking from Jackson Hole, talking about the cooling of the labor market. For more on that labor market and his takeaways from Powell's speech, we've got Andrew Levin. He's Dartmouth College economics professor and former Federal Reserve Board special advisor. Andrew, it's great to speak with you. I want to start right there on the labor market because it is the biggest risk to the Fed moving forward here. What do you think could happen to the path forward for the Fed if we do get a surprise in the upcoming jobs print on September 6th? Does that increase the likelihood of us getting a 50 basis point cut come November? September,
yeah,
rather.
Great. I think there are two ways the labor market can cool. One of them is lots of people losing their jobs. And that's happened in the past. We see it in the new jobless claims numbers when that happens. And that's driving, those layoffs drive up the unemployment rate. That's not what we've been seeing for the past year. In fact, yesterday's report's consistent. The new jobless claims yesterday was around 230,000. That's about where it was a year ago, not too different than where it was in 2019 before the pandemic. So there's not massive layoffs happening. So why is the unemployment rate going up? How is the labor market cooling? And the answer is a lot of people are joining the labor force. And in particular, when you look at people 25 to 54, it's been amazing over the last few months that the number of people in that age group, the kind of core, we call them prime age workers, joining the workforce, looking for work. Now, why is that happening? Well, it's because people's pocketbooks are tight. Prices have gone up a lot. Wages haven't caught up with those increases in prices. And so families need to have more hours of work in order to meet their expenses. So the labor market is cooling, but it doesn't look anything like a recession, certainly not a standard recession.
So then, Andrew, I guess my question is, how do you see the Fed then factoring that into their future policy decisions, just given the fact, and Powell talked about it, just the supply dynamics and why it is so different than what we had seen in the past. And then I guess to piggyback off of that, what does this then do, I guess, your overall impression of the speech and the confidence that Fed Chair Jay Powell still seems to have that they are going to be able to pull off a soft landing?
Okay, great. I think the first thing is I would be extraordinarily surprised if the Fed cuts rates by 50 basis points next month. Mm-hmm. I just did not hear that at all in Chair Powell's speech this morning. The words he used was there's ample room for easing, and that the Fed is strongly committed to supporting a strong labor market. He didn't say that the economy is about to plummet into recession, that they're not in emergency mode, which usually would be the case where they start making really forceful, large, extraordinary cuts. This is not emergency, it's a pivot. And so I think what's probably coming is a quarter point cut at every meeting for the next 4 meetings in a row. That would cut a percentage point. Mm-hmm. And then they'll start to see, as they have in the past when they've done either a normalization cycle. Usually it was raising rates up. In this case, it's bringing them back down. So it could end up being a full 2 percentage point cuts. That would be 8 meetings in a row of a quarter point each, and maybe a pause here or there. So that means 8 meetings from now would be basically the middle of next year. The federal funds rate could be 2 percentage points lower than it is now if they continue to see inflation subsiding to the target and the unemployment rate is close to where it is now. Maybe more people join the workforce. Maybe some of that levels off. The critical thing, the reason why the Fed needs to ease rates is so that those people can find jobs. We want a strong labor market. We want families to be able to meet their expenses. That's part of the Fed's mandate, along with price stability, is to support full employment. And so I think there's definitely ample room for them to support a strong labor market right now.
Andrew, given that you have been an advisor on the Federal Reserve Board previously, I want to get your take on some advice for the Fed. I know you'll remember 30 years ago when Bernanke said that central bankers are firefighters. They're fighting the fire right in front of them. If the Fed is so data dependent, are they potentially missing the forest through the trees because they're so focused on what is right in front of them and maybe not looking ahead to potential further economic risks that could even include a reacceleration of inflation down the road?
I think that there is certainly a risk that we have a false dawn with inflation. A lot of the improvement in inflation has been on the good side. Rental rates, for example, in the housing market are still strong. And by the way, this morning's new home sales report was great. Sales up 20% over the last 2 months. It's a big revision, and some of that could be revised again. But it looks like things are going better in housing construction. But house prices are high, rental rates are still going up, and that could potentially feed into other kinds of inflation over time. So the Fed's got to keep an eye out, be attentive to those risks. But probably, as Chair Powell said, there's ample room right now to move toward easing policy to support a strong labor market. And as I said, I think my base case is that they cut a quarter point per meeting. Starting at this coming meeting, they'll use language in the next statement kind of along the lines of they're going to be continuing to ease gradually as long as the data is consistent with that. But they got to be attentive to the risks.
Andrew, we heard real quick, we only have about 30 seconds here, but Powell was talking about that that Fed officials need to rely on lessons that have been learned when they're applying that to the future strategy and some of those future challenges. I'm curious, from your perspective, obviously following this all very, very closely, what would you say is the biggest lesson learned at this point?
The single biggest thing that they could do to improve right now is to start doing scenario analysis and contingency planning. I've called it stress tests for monetary policy. And that would become part of their public communications to explain where do they see the risks, what kind of risks, how big are those risks, how would they respond if those risks materialize. The Fed's never done that before, at least not in their public communications. It would be helpful. It's like a weather forecaster talking about where the hurricane might hit, or a medical doctor, a team of physicians sort of talking through, here's what we think given what we know now, but here's what could happen, and here's how we would respond to that. And that helps the patient and the patient's family to stay calm and to get healthy.
All right, Andrew Levin, always great to get your insight. Thank you so much for taking the time to join us here. Dartmouth College economics professor and former Federal Reserve Board special advisor. Thanks, Andrew.